All right, let's dive right in. Today, we're talking about one of the most legendary, but also one of the most misunderstood strategies in all of finance: short selling. It's got this reputation as a super slick way to profit from failure, right? But let me tell you, behind that very tempting idea is an absolute minefield of hidden risks.
I mean, just think about that for a second. The whole idea is incredibly seductive. You see a company, you think it's way overvalued, maybe it's heading for some serious trouble, and instead of just, staying away from it, what if you could actually profit from its decline? It sounds like the ultimate investor power move, doesn't it? But that power, well, it comes at a very, very steep price. So here's how we're going to break it down in this explainer. We'll start with why this bet is so alluring and walk through the basic game plan. But then we're getting into the real meat of it, the concept of unlimited downside. What happens when the market decides to fight back, and all the nasty hidden fees that can just eat you alive. And we'll wrap it all up with our final, pretty perilous verdict. Okay, so let's look at how this is all supposed to work. On paper, the game plan looks surprisingly simple, almost elegant. But you have to understand, these simple mechanics hide a process that is just so much more dangerous than it first appears. Here's the textbook version, the perfect scenario. First, you borrow shares of a stock you're convinced is going to tank. Let's say you borrow 100 shares of a company and they're trading at 50 bucks. Step 2, you immediately sell them on the open market. Boom, $5,000 in your pocket. Then you wait. And what do you know? You were right. The stock drops to $30 a share. So you swoop in, buy back those 100 shares for just $3,000, return them to the lender, and you just made $2,000. Simple, right? Well, only in a perfect world. So that's the core of it. You're selling something you don't actually own, with the hope, the expectation, that you can buy it back for cheaper later. And that one little detail, that you're selling something you borrowed, that's what creates the fundamental, terrifying problem here, the massive, mind-bending difference between how much you can possibly make and how much you can possibly lose. And here we are. This is it, the single biggest, most terrifying risk in the entire game of short selling. Honestly, this is the one concept that separates it from pretty much every other kind of investing and makes it just uniquely, spectacularly dangerous. Now check this out, because this is where everything gets turned upside down. When you buy a stock the normal way, your risk is capped. You spend $1,000, the absolute most you can lose is that $1,000. That's it. But your potential profit, technically it's unlimited. The stock could go to the moon. With shorting, it's the complete total opposite. Your maximum profit is capped. A stock can't go lower than zero. But your potential loss, it's unlimited. Infinite. And this visual just drives the point home perfectly. Because a stock's price can, in theory, just keep rising forever and ever, the amount of money you owe to buy back those shares you borrowed can also rise forever. You sold at 50 bucks, feeling clever. But what happens if it goes to 100, or 200, or 500? Your losses just keep piling up, and there is absolutely no ceiling. So, as if the idea of unlimited losses wasn't scary enough, you also have to deal with the market itself. And the market is this wild, chaotic force that couldn't care less about your brilliant thesis. It can turn what looked like a smart bet into an absolute catastrophe in a heartbeat. And there are a few key ways the market really loves to fight back. We're going to cover the most explosive one, the infamous short squeeze, but also the huge problem of timing, the danger of unexpected good news, and the nightmare scenario of a buyout. So if you've ever heard about the whole GameStop saga, then you've heard about a short squeeze. This is what happens when a stock that tons of people are betting against suddenly, and for no good reason, starts to rise. And that initial rise can trigger this cascade of pure panic that defies all logic and fundamentals. So here's how this vicious cycle gets going. The stock starts ticking up, maybe just a little. Short sellers see their losses starting to mount, and they start to panic. Now, to get out of their position and stop the bleeding, what do they have to do? They have to buy shares. But this sudden rush of people being forced to buy acts like pouring gasoline on a fire. It pushes the stock price even higher, which in turn forces more short sellers to panic and buy, creating this absolutely devastating feedback loop. And it really is a snowball effect. The momentum can become totally unstoppable, and it's not driven by the company's actual value anymore. It's driven by the pure, raw panic of short sellers who are just desperate to escape. It's a phenomenon that can, and it absolutely has, wiped out gigantic, sophisticated hedge funds in just a matter of days. And a squeeze isn't the only trap out there. There's the timing problem. You could be 100% right that a company is doomed, but if the stock price goes up for 6 months before it finally collapses, you could be forced out with massive losses long before you're ever proven right. A surprise positive earnings report can send a stock soaring. And then there's the ultimate nightmare for any short seller, a sudden buyout announcement. That can cause a stock to jump up huge overnight, leaving you absolutely no chance to escape.
So if fighting the market itself wasn't already hard enough, there's a whole other layer of risk that's just buried in the fine print, the rules and the mechanics of short selling. These are the nasty procedural traps that a lot of traders don't even know exist until it's way, way too late.
So we're talking about things like margin calls, these really costly borrowing fees, something called share recalls, and even sudden regulatory changes that can trap you in a really bad position.
Okay, so as your short position loses money, your broker starts getting pretty nervous, and they're going to issue what's called a margin call. It's basically a demand, hey, put more cash in your account right now to prove you can cover this growing debt. And if you can't come up with the cash, oh, they won't wait. They will forcibly close your position for you, locking in your loss at the absolute worst possible moment.
And remember, you're borrowing those shares, right? That's not free. You have to pay interest on them. And if a whole lot of people want to short the exact same stock, it becomes hard to borrow. When that happens, the fees can become astronomical. I mean, they can act like a constant tax, just draining your account day after day. It's totally possible to be right about the stock falling, but have those fees eat up every penny of your potential profit, and then some.
Oh, and the traps don't stop there. The person you borrowed the shares from can demand them back at any time. It's called a share recall, and it forces you to close your position, ready or not. Regulators can suddenly ban short selling on a stock, trapping you. Or maybe the stock is so thinly traded, there just aren't enough sellers, making it physically impossible to buy back the shares to close out. The scary part? All of these things are completely 100% out of your control. So, when you put all of this together, the unlimited risk, the market fighting you, the hidden fees, it becomes so clear that short selling is not just investing, but upside down. No way. The entire structure, the psychology, the risk, it's all fundamentally different and just so much more dangerous. And just think about the psychological pressure here. The stock market, over the long term, has a natural tendency to go up. As a short seller, you are fundamentally betting against that upward drift. You're fighting the tide every single day. Watching a stock go up while knowing your losses are infinite creates a level of stress that is just unbelievable. And it's the perfect recipe for making panicked, emotional mistakes. I think this slide just sums it up perfectly. When you buy a stock, you own an asset that can grow. But when you short a stock, you owe something that can get more and more expensive. The outcome of one is about building wealth, often slowly over time. The outcome of the other carries the constant risk of destroying your wealth in an instant.
And that really is the final verdict. While this might be a tool for super experienced, highly sophisticated professionals, for most people, the risks they're just too great. The market can be a brutal teacher, and in the game of short selling, it punishes ignorance with incredible, incredible speed and aggression. So I'll just leave you with this question to chew on. After seeing all of these hidden traps, the unlimited risk, the psychological warfare, is short selling a sophisticated strategy for financial geniuses, or is it, at its core, a trap just waiting to spring on the unprepared?